right, well, guys, welcome. But I got bad news. If you've been listening to me for the last 10 years, it's going to be more of the same. I went through a bunch of the data today. I go through it every day. I listened to Atom Data, ATTOM. They just had their distressed real estate webinar. So it's all about foreclosures and what's coming down the pipeline. And then they actually had these 3 projected models. And they were like, here's the worst case scenario. World's going to end. There's going to be all these foreclosures. And they had a chart where it had number of foreclosures by year. And we peaked in like 2009 or 2010 at 1 million foreclosures. And they said, look, if it is that bad, based off the data that we have, it's going to look like the foreclosure market in 2015. Which was non-existent. It was like 300,000 or 400,000 nationwide. So the guys who actually see all the data and in the data every day are like, even if the world completely ends, it's not going to be 2008 all over again. So I'm going to go over a bunch of data with you guys today. I am out of the convincing business. I've just realized that some people believe there's a big real estate crash coming and the economy's coming to an end, and I don't see it. I'm out there every single day. I'm talking to banks. I'm talking to investors. Now, people are getting scared, but they're just not. I'm like, where does all the inventory come from for a big real estate crash? Where is the big crash in demand? And I'm not seeing it. If you guys have tried to get a loan in the last 90 days, you know what a giant pain in the ass that is. So it's not like we're lending money to people who can't afford it. So this is completely different than 2008 and 2009 all over again. In fact, this reminds me a lot of what happened in COVID. During COVID, everybody got really scared. Investors kind of dropped off the face of the earth, and we went in and bought everything we get our hands on. That's when we bought this building. And it looks a lot like that for probably about 18 months. And it's going to depend on interest rates. But I'll get into that in the presentation. I'm calling this one a bifurcated market. There's going to be 2 things that happen. The higher end market is slowing down. We can absolutely see that. These are the really expensive homes, luxury homes. In fact, I'm making offers on stuff over $1 million or close to $1 million more than I ever have in my career. It's kind of wild. I made an offer on a place here in Houston at $1.2 million. And it will actually cash flow, if you can believe that. And then this morning, I made an offer on a property. ARV is probably $1.2 million. So I'm getting into the marketplaces that are experiencing trouble. Below $350,000, those are appreciating 15% a year. Like, you can look at the latest HAR data. It said between the report that came out this month was for last February. We're up 1.6% annually. The raw data is available on HAR. I can show you where it's at, and it's on the public-facing side so you guys can see it. Below $350,000 in markets that have at least 30 transactions a year, we're up 16%. So folks are waiting for the other shoe to drop, for prices to come down. I'm like, they ain't coming down. Like, they're just not. I sold a 4-pack of beach houses in Surfside in the middle of winter. They sold in like 10 minutes. I've got 2 other beach houses for sale, and those will take a little bit more time because they're a lot more expensive on a per square foot basis. But in the last week, the stuff that's gotten listed is just mind-boggling how expensive it's getting. So in any case, I'll go through all the stuff here tonight. Disclaimer, I'm not a CPA, an attorney, a doctor, an auto mechanic. The biggest mistake I see people make in this business is they pay for legal advice or accounting advice or whatever it is, and they don't use it. So you guys should talk to your attorneys, your CPAs, all that stuff. And any numbers presented here today are for demonstration purposes only and are not meant to apply a guarantee of earnings or outcome. One of my favorite stories is I like talking about Corpus Christi. It is a great, great market. I bought 1 in December, and I contracted, this is in my personal portfolio, 1 or 2 here in the last couple of days. And I'm closing 2 in March. So I contracted those in February. And it's a great little market. Some guys that were not in our mastermind went down to Corpus Christi, bought some properties, got their ass absolutely kicked down there. The problem with Corpus Christi is the crews. You got to get the construction done. It's super hard down there because anybody who's good at swinging a hammer or turning a wrench works in some sort of manufacturing. It's the ship channel, it's oil and gas, it's that sort of thing. So you actually have to bring your crews in. Otherwise, you ain't gonna get your rehab done. That's what we do. They stay at our beach house. So anyways, I said this back in 2017, and by God, it's still relevant today. I got on the radio show, and I said, if you think real estate's expensive now, just wait. Everybody laughed their ass off. In fact, for like a year, anywhere I would go, they're like, let me guess, you think real estate's expensive? And I'm like, yeah, you're about to find out. And that was before COVID. So I could see the numbers is pretty clear. Inventory is continuing to shrink. Demand is continuing to increase. So what happens to prices? They just keep going up. So I'm going to go over kind of what's happened and what's going to happen here in the future. This is a quote from Logan Mohtashami. Logan is the chief analyst at Housing Wire. He is one of the sharpest guys right now in real estate. I think Housing Wire is $300 a year. If you guys are really nervous about the market, you got to have the most up-to-date data. I would buy a Housing Wire subscription. It is absolutely fantastic. Logan just sits in the data every single day. He is doing a market update every single week. They didn't do that before, but they are watching the market like a hawk. So he's doing an update every week. And then the guys at Altos Research, which all they look at is forward-looking data. His name is Mike Simonson, and Mike is doing a weekly podcast on Mondays about all the future data. And this is what they keep saying. Wow, isn't it interesting? Inventory is still shrinking. New buyers are not coming on, or new houses are not coming on the market, and a handful of buyers keep entering the market. So they're protecting, the market is self-correcting, and it's protecting prices. It's really what's going on. This was before 7% mortgages. If you guys are looking, mortgages essentially hit 7% in the past 2 weeks. So we're going to see what that does to the market. And we'll talk about what that's going to do to demand and supply. If you have not read this book, this is the book to read on the housing crash. It is absolutely, some of the guys, y'all have read, huh? A couple of you guys in Mastermind, this is required reading. So Aaron Clary was a credit analyst in the Twin Cities for a bank there. He's a banker. He worked mostly with developers. And one of the things you will find in his book is it was just bad risk management. But at the same time, so much stuff had to happen. Like so many things had to happen in order for the crisis to occur. And in fact, if you guys want, have you seen the new Bernie Madoff documentary on Netflix? It is spectacular. Like he was running circles around the SEC. And the only reason they caught him is because of the financial crisis in 2008. They would have never caught him, ever. Would have never caught him. You guys have got to watch it. It is really good. Anyway, so Aaron published his book the day Lehman Brothers collapsed. So to date, he's the only guy that published the book before it happened. So he has a really good idea of how it occurred. But like I said, the big takeaway on this is, man, a lot of stuff had to happen. And this doesn't look like 2008 at all. Here's the other problem. So let's talk about a real estate crash. Here is the problem. Homeowners are in great shape. This is not like 2008, 2009 all over again. I have friends of mine that have been in the mortgage industry for over 20 years. They have never seen this chart. I just stumbled on it about a year ago in some random presentation somebody sent me. And now I get an update usually once a year on this thing. Sometimes I get it a couple times a year. This is mortgage originations by credit score. So let's just look at a 720 credit score or above. If you've got a 720 credit score or greater, your default risk is almost zero. Those people do not default on loans. This is Q1 2003. This is 720 or greater. This is 720 or lower. So let's just look at 720 or lower. So if you look here, it kind of trucks along like this. And then what happens? 2008, there's Q1 2008. Hey, there's a real estate crisis going on. There's actually a credit crisis going on. If you remember, bankruptcy law changed back then, so a lot of people were filing bankruptcy. It was a really interesting time. So what happens? Lenders say, that's it. You don't have a 720 credit score or greater, we're not lending to you. So this is what happens. Boom, the market just shrinks. This is 720 or greater. This is 720 or lower. Look at this. It just never comes back. If you didn't have a 720 credit score or higher, it was really hard for you to get a loan. You compare that, this is almost 50% of loan volume is 720 or greater, or 720 or lower. And then after 2008, it's just a minuscule amount. So the people that we are lending money to can pay their bills. These people are not going to get foreclosed on. Although I say that and I'm buying 2 foreclosures right now. But I will tell you this. When you look at Google Earth on one of them, look at like the street view, there are like 10 cops out in front of the house. So I don't know what's going on, but typically folks who have a 720 credit score or greater don't have cops hanging out in front of their house. This is homeowners equity. I'm going to show you another chart later with how many people are buying with cash. We have never had this much equity in our homes in the history of the United States. Nearly a third of homes are bought with cash. I'd have to go back and look. It's 40 or 60% of the housing market is owned free and clear. Really hard to lose a lot of real estate when you own it free and clear. The bank's not foreclosed on it. You lose it for taxes, but the bank isn't going to foreclose on you anytime soon. So you guys have heard of mortgage affordability, the affordability index, all that stuff. I think it's all bullshit. The math doesn't make any sense. It says, well, here's this neighborhood. In this neighborhood, the houses have appreciated to $400,000. Oh, you know what? Let's use my neighborhood in Spring Branch. Here in Spring Branch, the houses are now $500,000. Median home price, section of Spring Branch, $500,000. But the median income is only $67,000. Well, those people can't afford those houses anymore. And I'm like, okay, well, here's the problem. Most of those people moved in 30 years ago when the houses were like 10 grand. So why are the houses selling for $500,000? Simple. Who's buying houses right now? People who've got enough money and enough credit to afford a $5,000 house. The real estate market runs on what I like to call 3%. Meaning only 3% of the market is ever on sale at any one time. That means 97% of the market is not on sale. It's a marketplace in which operates what's called on the margin. This little teeny tail over here. You have all the houses right here. Oh, that's a crappy Gaussian curve, isn't it? All right, you got all the houses right here, and it's only these that are selling. Everything else is already owned. And most of them have what? A fixed rate mortgage, right? They either own a cash or it's a fixed rate mortgage. Very few took out variable interest loans. Very, very few since the financial crisis. Very few. So only 3% of the market is for sale at one time. So whenever they throw that housing affordability index thing up, I'm like, this is the stupidest thing I think I've ever seen. It's kind of like saying, new cars are $60,000 and the average American can't afford a new car. I'm like, well, the average American ain't buying a new car every year. It's a very small segment of the population. This is a much better metric. This is from the St. Louis Fed. It is mortgage debt service payments as a percent of disposable personal income. Meaning, I have to service the debt of my mortgage if I have a mortgage. How much as a percentage of my personal income goes to satisfy the debt of my mortgage? Just so I know this is a reading test for some of you guys. Like I had LASIK a couple years ago and they told me, when you hit 45, you're gonna need those readers. By God, they were right. It was like the day I turned 45. Anyway, this starts all the way back to like 1980. That's 2023 over there. Houses have never been more affordable from a percentage of disposable income. That's what the chart says. It's pretty simple. This is how much, after my bills and everything else, is how much money I've got to pay my mortgage, and it's never been lower. The cost to buy a house has never been, well, I shouldn't say never been lower. It's actually lower right here, but it's coming back up. Wages have gone up. That's really another way to say it. So I think I'd have to remember the metric. I don't have it in this presentation. I think 60% of homeowners have a mortgage that's 4% or less. 60%, 4% or less. It is amazing. Most rents are more than mortgages. In fact, in one of my neighborhoods that I live in, I'm rehabbing a house. It looks like I'm gonna end up rehabbing another one. But anyway, a house just sold for, it's under contract for $270K. Those were going for $260 last summer. So we're kind of in the dead of winter, and it sold with 4 days on market. Now, last summer it would have sold in 7 minutes, but instead it took 4 whole days for them to get and that's what, it could actually go higher than that. That's what it's pending at. It's pending at 270. So houses have never been more affordable. So I don't really buy the whole affordability index. I go back to this. It makes the most sense. All right, let's talk about more foreclosures. So here's what happens in the foreclosure process. There's a delinquency first, meaning I can't pay my mortgage. It is late. So you're probably reading some statistics on social media and all the news channels and all that crap that says, oh my God, foreclosures are up 2,697%. Delinquencies are up 50,000%. I'm like, well, because we were in the middle of COVID, we couldn't file for foreclosure, right? So this is delinquency. So we're on the far right here. This was right before the pandemic. This goes all the way to 2009, it's 2010, 2011. Obviously, delinquencies jumped in March and April of 2020. Why was that? Because Donald Trump got on TV and said, don't pay your mortgage. That was great, wasn't it? I love that. I voted for it, and then he just said, no, they shouldn't pay you. I'm like, excuse me? I thought the guys on the other side of the aisle were crazy. This is the pre-pandemic era here, and you can see our delinquencies are about where they were before the pandemic. You guys keep hearing about the jobs reports, right? In fact, we're going to get jobs reports. I think we get one this week. Should be tomorrow, right? I'm like, it should be Friday. So what's funny is Brandon there is running victory laps in DC about how great jobs are. And I'm like, look, dude, if we didn't have the pandemic, we would have already surpassed this number of jobs. Like, we're just now getting back to pre-pandemic job numbers. But anyway, I think it's hilarious. It's like, dude, talk about mediocrity. All right, so these are foreclosure starts. So we've begun the foreclosure process. We've what's called accelerated the mortgage. We sent a demand letter. Hey, dude, you're not paying us. You need to pay me. I am taking you to foreclosure. These are called foreclosure starts. That's what that looks like. We're getting ready to go to foreclosure. You've gotten all the nasty grams from the attorney. In Texas, this is how you do pre-foreclosures. You can search for what's called a substitute trustee. That's when you can see foreclosures like really getting going. You can pull them from county records, super easy. Anyway, this is 2008, 2009. Obviously, lots and lots of foreclosures. And then here we are. By the way, this is almost 600,000. This line right here is 100,000. Weren't a whole lot of foreclosure starts in 2020. Why? There were no lawyers in their offices sending out nasty letters. It's a pretty small number. So we're sort of approaching pre-pandemic foreclosures, but not really. Kind of getting there. This is completed foreclosures, otherwise known as other real estate owned. You have been foreclosed on. The bank now owns it. What are they going to do with this piece of junk? That's what I found. The 2 properties I'm buying right now, they just happen to be foreclosures. I didn't know it until we talked to the agent. They go, yeah, they'll take your offer. They were like, send us a contract. We send the contract, and like 2 or 3 days later, we're like, why haven't they signed the damn thing? And the agent gets back to us like, well, it's at the disposition department because it's an REO. I'm like, oh, no shit. They're doing those again, huh? So we had to wait like 2 weeks for the dude to sit down and actually sign it. So in any case, here is likely what happens. Before it gets to this place here, homeowners just sell. They get all the nasty grams from the attorney. That's all the pre-foreclosure. I'm taking you foreclosure. I'm taking you and taking. We're going to foreclosure. And they go, oh God, we got to get out of this house. You know what? Why don't we just sell it, take what we can, and move? And that's what ends up happening most of the time. So your actually completed REOs are super low. This was as of, I think, Q3, Q4 22. So Adam, I was on the Adam webinar today. They can see forward-looking foreclosures, and they can kind of predict completion rates and that sort of thing. And they said, we're still about 20% below pre-pandemic. And he said, I don't know if we're going to get to pre-pandemic levels of foreclosure. And he just said, they got so much equity. There's still demand in the marketplace. If people can catch a deal, they'll do it. I mean, this, like I said, this one right here sold in 4 days. So there's still a lot of buyers out there. All right, let's say there's a crash. I know some of you guys like to dream about real estate crashes. Oh my God, I'm going to go into A-Leaf and I'm going to buy everything at $25,000 a door. You're just dreaming about it. All right, this is what it looks like. Now this is nationwide. It's actually even worse in Texas, but anyway, this is nationwide. If U.S. home prices fell 10% peak to trough, it would take prices back all the way to October 2021. Way back when we were still wearing masks on airplanes. All right, so what happens if we have a 20% crash? Oh my God! We go all the way back to February 2021, 2 years ago. So when people were telling me back in February 2021, real estate's too expensive, there's gonna be a big crash, I'm like, we had a 20% crash. It would only go back to February of 2021. So I don't know what folks are expecting. Now, like 40, 50% crash, it takes you back to like 2019. Like a 50% crash takes you back to like I'd have to go back and look at my data, 2018, 2017. If you guys go to Google, type in HAR report, you can they have all the historic reports. You can look at median home price, just cut the number in half and go looking for what month and what year, and it'll tell you right there. So that is what a real estate crash looks like. All right, what about other assets? This is an excellent article. It's a year in review written by a guy by the name of Dave Collum. Dave is a pretty sharp guy, and he's pretty funny to boot. He is a tenured faculty at Cornell in chemistry. He's just a chemistry prof. He's a successful chemistry prof. And he started investing for retirement, like everybody does decades ago. Well, then he started blogging about it. And he amassed this huge following. And what he does is he's got like a file that sits on his desk. It's on his computer. And he sees interesting news stories and drops them into this file and then writes an annual year in review. It's 200 plus pages, and I highly recommend you read it. It is really, really good. He talks about social stuff, political stuff, and then he gets into the financing piece. Every year I take a swipe at valuations. 2 years ago, I went at the egregiously overpriced FANGs and related tech garbage. Moreover, the FANGs et al. Have an enormous collective market cap compared to the dot-coms that caused pain. Although the FANGs et al. Humiliated me in 2021 by continuing their moonshot, their 2-year returns are slightly sobering and exonerating. So this is 2-year total returns of the FANGs starting in 2020. Amazon, -43, Apple up 9, Facebook, -6. Anyway, so you can kind of see all these. My favorite, if you guys remember, these are actually Zoom is actually what's called a COVID stock. Did really great during COVID. They're down 81%. So when people are talking about, well, real estate's doing this, real estate's doing that, I'm like, I don't know, man. I look at other parts of the portfolio, it's a mess. But this was one of my favorites. Now, this is a cryptocurrency, Luna. Now, I will tell you this. The rumor on the street is somehow FTX got involved in the collapse of Luna, and we don't know why yet. I'm sure it's going to come out in court, but that's the real interesting rumor that I'm hearing in all the finance boards. But this is really interesting. Luna fell 99% from $100 to $1. And I could see this. I'm in a bunch of crypto space. I do not invest in crypto, but I'm in those spaces reading what those guys do. And we have some investors I work with from time to time that are crypto guys. So they're like, oh man, Luna's down. We got to pile in, dude. You need to mortgage your house. Get in. And I'm like, fuck that. I'm like, it just fell 99%, dumbass. It's not at zero yet. So it falls 99% to $1. Then it falls another 99% from $1 to a cent. An important lesson here, if an asset falls 99%, it can still fall another 99%. Like it can just keep going. Like it can, zip right to zero. It's a long fall, right? 99%. I'm like, I've got my ass kicked a little bit in real estate, but I've never had that happen. I'm like, that's pretty shitty. All right. This is the annual report. If you guys are on HAR, you can see it. This is the annual review. I said last year, about this time, 2 weeks before this time, right around middle of February, Valentine's Day, I said we will probably hit 13% median price appreciation, and we landed at 12.8. Now, I will tell you this. The modeling I did do did not anticipate mortgage rates doubling in a year. That's never happened. If you had told me last year, like, oh yeah, Jason, rates are going to double, I'd be like, there's no way in hell. And I'm like, I don't even know what that would do to the housing market. Like, I can't even envision that. Now, looking back, I'm like, how incredible is this marketplace? You can double rates and prices keep going up. Yes, sir.
Jason, yes, that has happened in the past. It's not when you were born, but before, around in the 80s, they doubled.
Oh, and I'm going to get to that. Because I'll give you the shortcut of it. If we believe that, well, I'll get into it here in a minute. Something I heard really interesting today. So rates, well, let me put it this way. If I sat in this room a year ago and said rates are going to double and we're still going to appreciate 13%, everybody would have thought I was crazy. But for the fact that it happened previously in the 80s. That's what's very interesting, is everybody forgets this. Everybody forgets this. You can pull it up on the Fred database. I was going to do it today, but I was making a bunch of offers, writing contracts. I got busy doing stuff that actually makes us money. Anyway, you see this 80s right here, and then you see this bang. Rates go up, and then rates kind of come down, and it looks like this. You can actually overlay this chart with the price of real estate, single-family homes. You know what it looks like? This. Everybody forgets that real estate follows inflation pretty closely. When you bought a house in 71, by the time you get to 83, it didn't go back to the same price in 1971. So whenever I talk to somebody and they're like, Jason, you understand rates can do this, rates can do that, go through the roof and real estate's going to crash. I'm like, when the hell did that happen? So sure, if it was going to happen, it was going to happen here. When you were at, what was the peak? 18? The prime rate, was it 18, 16 or 18? I can't remember. It was just below 20%. It was wild. Absolutely wild. So whenever I talk to investors and they're like, yeah, man, but rates can like go through the roof. And I'm like, I keep looking at the data. I'm like, oh, it doesn't seem to me like price of real estate and interest rates are correlated. That doesn't seem to be, I keep hearing all these experts saying, price of real estate, or interest rates going up, price of real estate's going down. I'm like, no. Now that's sort of true in commercial. And we're finally starting to see the crack in the CMBS market. I talked about that 6 months ago. First article came out today. Blackstone's defaulting on a bunch of their notes. Bunch of their CMBS notes for a subsidiary they bought, I think about 6 months ago. But I keep pulling this up and I'm like, I don't see it. Single family operates a little bit differently. Actually operates a lot differently. This is national inventory as of today. And we just can't get enough houses on the marketplace. There's a number of reasons for this, but in order to have the collapse that we had, we've got to get to somewhere around 4 million homes in the market. I just don't know where we're getting those houses from. Homeowners have a lot of equity. Homeowners have got they've got cheap mortgages. If you actually bifurcate the market between homeowners and non-owners, homeowners' wages are continuing to increase, meaning they can afford their mortgages even more every day. I don't know about you guys, but we're hiring people around here. We cannot find enough people. So in any case, I don't know where the inventory comes from. This is the Realtors Confidence Index Survey. I think this is a stupid name for this thing, but that's okay. The more important piece is this right here. First-time home buyers. So the dark blue is December 22, the light blue is December 21. First-time home buyers, we had more, just slightly more, first-time home buyers in December 22 than we did in 21, despite the fact that rates doubled. Sales to investors. Everybody keeps talking about, Jason, all these investors pulled out of the market, and like Zillow's not buying homes, and neither is Open Door. And I'm like, well, it looks like they're buying just a little fewer, 17% of the market to 16%. I mean, don't get me wrong, 1% is substantial, but they're still there. Now, isn't this interesting? Cash sales. December 21, 23% of the market was cash sales. Now it's 28%. Isn't that interesting? My former business partner, Tom, used to say this all the time, and he's 100% right. He'd say, Jason, here's how you know when a market is at a bottom. When cash buyers step in and say, I'll take everything at that price. That is the bottom of a market. Now, obviously that's not 100% of the market, but they're 30% of the market. Now, I don't know what percentage these guys are sales to investors are to cash sales. That's always kind of a murky sort of thing. But 28% of the market is cash sales and a 16% of the market is investors. And the first-time home buyers are still buying. Not very many distressed sales, which kind of makes sense. And obviously, days on market have jumped. I think we're around, I got this for last month, I think we're at like 33, which is good. We need to be at about 30. Anything less than that is like just crazy. The markets are just nuts. All right, this is the most important chart in real estate. When I am finally on Tucker Carlson's show, getting grilled, this is what I'll have. I'm like, Tucker, we're only talking about this tonight. What about this? Like, no, Tucker's all we're talking about tonight. All right. The red line is new home sales, number of new home sales. The green line is median new home sales price. And you can see here, starting in the 90s, that they move along in concert with each other. And then something happens here in about 2007. And then all of a sudden, there's a huge drop in the number of new homes built, but the price keeps going up. In fact, this is right before mortgage rates went up. This is what it looked like. It's come down just a little bit, but then so have the number of new homes built. So what happened here? So Barney Frank and his buddies in Congress passed a bunch of consumer protection laws. One of the little known things that they passed is they limited the number of, or the amount that regional and local banks could lend to developers. So when you look at your D.R. Hortons of the world, your Toll Brothers, any of those other guys, they don't do any development. They roll up, they buy a bunch of lots from a developer, and then they start putting homes up. So who does development? It's guys like us. We buy a piece of land, typically we borrow it from a bank, we move a whole bunch of dirt around, put in the utilities, put in the streets, and then we start selling those lots to home builders. Well, they limited the amount of money that we could borrow from banks. So what did that do? Development work just crashed. If nobody's moving dirt around, putting in streets and utilities, you can't build a house in the middle of the forest. So there's just no land for these folks to build on. That's one of the things that's causing this huge problem with new home construction. I don't see this changing anytime soon. This is inside some consumer protection legislation. So some adult at some point is going to say, all right, we need to repeal this portion of the can't remember what it's called, Consumer Housing Protection Act or whatever it is. And then somebody on the other side of the aisle is going to say, no, you're trying to hurt consumers. Such a bad guy. And you're like, no, you don't understand. If developers don't have money to go develop land, then we can't build enough houses. And they're like, yeah, but you're trying to kick people out of their homes. Like, no, we're trying to build more houses, but there's only so much that they can lend. Anyway, so that's never going to change. And it's probably just going to get worse as it continues. Let's talk about supply chain. Supply chains are never returning to normal. And I'll show you a bellwether signal, maybe a canary in the coal mine, that will tell you when supply chains come back to normal. We are not seeing supply chains coming back to normal anytime soon. I'm not seeing it, especially on the big manufacturing side. So it's not necessarily just the supply side. So in inflation, there's two types of inflation out there. There's supply, and then there's demand. Now, just because prices go up doesn't mean that's inflationary. This is a little bit harder concept to pick up on. So the Federal Reserve is trying to fight supply-side inflation with interest rates. And that just isn't working. Like, that's not working at all. Because prices are still what? Going up. It's actually the rate of inflation. That's what they're trying to fight, is the rate of, actually, you could call it this, the rising rate of inflation. That's what they're trying to fight with interest rates, and it's just not working. I'll get into a couple of my predictions here, and then we can do Q&A. I am seeing some really interesting trends. One of those is fewer new listings. So if you talk to guys like Logan Mohtashami, Logan will tell you that most home buyers are also home sellers. Meaning if they're going to buy a house, if they're going to sell their house, it's because they found another house to buy. Very few people sell a house and then don't move back into another house. It's pretty rare. I mean, it happens like as you get older, hey, maybe we got to sell mom's home, move her into her home or move her into our home. But it doesn't happen very often. So the current thought process is, unless you have to move, then you're moving. But a lot of people are like, hey, I got this 2.5, 2.8, 3.2% mortgage, and I'm just not really willing to give that up just yet for a 7% mortgage. In fact, what we're going to start to see for the summer is the impact of a 7% mortgage that started this week. It's actually the next thing we're going to see. It's going to get really interesting. There are slightly more buyers out there, just slightly. A little bit more buyers than there were at the end of Q4. So let me explain what that looks like. Where do we get buyers? Where do buyers come from? Buyers come from two places. This is what causes the increase in price of real estate. Buyers come from two places. Household formation and jobs. Those two, you can break down all of the Nobel Prizes in economics and real estate, and it comes down to those two things. For every 2 jobs created, 1 house is bought. That's simple. 2 jobs equals 1 house. Pretty simple math. Household formation. This is the millennials got tired of living in an apartment complex. Now they want to buy a house. The millennial generation is almost as big as the baby boomers. It is a gigantic generation. And they are now growing up and they are moving into their own homes. So this is creating huge demand for housing. I'm in a couple of groups on Facebook for like first-time home buyers and that sort of thing. And this gal posted this really she was bitching, but she had a legitimate concern. And it was a screenshot of Airbnbs in New Orleans. When she took the screenshot, and then another one from a year prior. And they had jumped something like 50%. And she says at the bottom of the post, gee, I wonder why we can't afford houses in New Orleans. And I'm like, ooh. I'm like, she's got a point there. The problem is there's no houses for them to buy. We can't build them. You evil landlords in here are turning them into short-term and long-term rental properties. Some of you guys are flipping them, but that's mostly what these people are doing. And it's putting enormous constraints on the market, which is where we're getting these massive price increases. And the other thing I've noticed lately is investors are sleeping. A lot of investors that were really aggressive, the market turned just a little bit and they got real quiet. So in the circles I run in, I talk to a lot of guys that flip houses and are really active investors. And what they're telling me is, Jason, I'm taking 10% off of the ARV on these properties. And I'm like, ooh, you're not going to buy a whole lot of real estate, are you? So one close friend of mine, it was him and his wife, and he had a whole staff. Like, they were a house flipping machine. They were doing 50 to 75 a year. Now she is back at work. He has fired all his staff, and it's just him doing a couple of houses a year. He's like, we were just really concerned about the market. And so I'm like, okay. Another buddy of mine, he works that southern market down there by NASA. And he said, yeah, I'm taking 10 to 15% off the ARVs on these properties. I said, how is that going for you? He's like, not well. And another buddy of mine, who I ran into, I hadn't seen him in 2 years. And he came last month to the event we're doing tomorrow. And I said, how are things going? He said, it's weird, man. There is nothing out there to buy. He flips a lot of houses and wholesales. He's like, there's just not a whole lot. It's like inventory. So the off-market inventory is at record lows, just like the on-market inventory is. He's like, sellers are holding on to their stuff. No one's really buying. He said, I'm doing some sub-2 stuff. I'm doing a little owner finance. You know, I buy something here or there, but there's just not a lot out there. Like, everyone's kind of staying put, even if their house, unless they desperately need to sell. And he said, when they do desperately need to sell, there's even more investors that are jumping in trying to buy these properties. And I thought, that's interesting. This is one of the most interesting metrics I think HAR produces. So if you go to the HAR report, on the left side, there's a drop-down menu. I can't remember where it's at, but it's a PDF of some kind of press release or something. They put this thing out every month. And it's got like number of showings. You know, we have 24,000 showings a month in Houston. Like, I had no idea we had that many shows. It's wild. So anyway, this is number of views. So this is HAR Listing Views. They track everybody who's on their website and what they're looking at. So this time last year, we had 56 million views. This time this year, we have 42 million views. That's a drop of 24%. There's 24% fewer people just looking at MLS. Some of the stuff that we've bought in the last couple of months, I'm like, how do we even, I started running the numbers on them. I'm like, why do we even see this one on MLS? It shouldn't even be here. Well, it's because investors are so scared. They're like, oh, I want to do it. And okay, that's fine. We'll go buy it. It's really interesting. 24% collapse. And you can see here, this follows a seasonality. This is pretty typical. President's Day, you start to see it kind of picks up, and then here we are, May, June, July. Usually your prices peak in May and June, and then they just come down through the Q4, August, September, October, November. Like I said, a really interesting metric. I assume that number of views correlate to number of sales, because if you're not looking at them, you're probably not buying them. Kind of makes sense. But I'm tracking this one. I think this is kind of one of the most interesting things. All right, here are my predictions for 23. If rates dip below 5.5%, you're going to see an absolutely wild market. It is going to be wild compared to COVID. I talked to a lot of agents that represent retail buyers, a lot of mortgage brokers, and they all tell me the same thing. Like, Jason, I have this huge pipeline of clients. Like, they are ready to buy. They are ready to go out. You know, they want to buy a lake house, a beach house. They want to upgrade, downgrade. They just want to buy, but they don't want to do it 7% interest. So then I'll ask them, I'm like, what do you think the number is? And a lot of times they'll say, you know, if we get down to 5.75, 5.5, I think we're going to see a lot of buyers enter the marketplace. And we're going to see a lot of activity. 5.5% is a pretty reasonable number. If rates stay above 6%, and we're now at 7 as of the last week and a half, I think you're going to see a pretty similar market to 2023 or 2022 in fourth quarter. We're going to have real mild appreciation as a marketplace, 2, 3, 4%, nothing crazy. It's going to be a real slow marketplace. I think you're going to see some investors that flip homes not make it because they were used to a market where they sell something in 10 minutes. I am seeing more development deals than I've ever seen in my career. I get sent 50, 60, 80, 200. I got sent a 1,000-acre land deal. for single family house development. I'm seeing a ton of those because they're not going to build for a couple of years now. The builders have, so we bought in one of our syndications, actually the Baytown syndication, Travis was calling around to a couple of supply houses. Said, hey, we got to do like 30 something roofs. We need to do a bunch of roofs here and a bunch of roofs on some other houses. So we need to do a big bulk order of roofs. So he calls one of the supply houses. I'm not going to tell you which builder they supply, but he said, hey, we just got a call from such and such a builder. They're going to finish out whatever they have under contract, and they're not building anything else till probably the end of 24. And I have all of their roofing material over here for the next, well, they anticipated they would be using this, but they're not. And I'll give you guys a really sweetheart deal if you take all of it. We were like, sold, take all of it right now. We'll take it because we're going to do all these roofs. So a lot of the builders have just stepped back and said, nah, we're not going to build any more houses. We're just going to wait till the market turns back around. So knowing that, I was talking to one of my agents. She's a pretty high-speed agent, and she is stealing some new construction. So I'm having some conversations with some new home builders that have got some inventory that is sitting, and I'm like, hey, if we can get it to rent, we will buy and buy and buy. There is nothing better as a rental property than a brand new home. The capital expenditures are zero. I mean, it's new everything. It's great. In fact, we have a project down in Corpus Christi. I close in March sometime. I'm buying a house with 1.5 acres on it. I think we can fit 5 or 6 houses on it. And we are building right now with our architect, like, what is that? A cute house, 3.2, maybe 4.2, 1,500 square feet, value engineered where it's got the appropriate number of windows, but it doesn't look like a cheap box, Want it to look like maybe a little bungalow kind of style thing, or maybe a ranch. How inexpensively could we build that? Literally with a couple of different, kind of similar floor plan, but just a couple of different front elevations, and start building build to rent. If you get the land cheap enough, it makes a lot of sense. So we're flirting with that right now. In fact, that's actually what's saving the construction industry right now is build to rent. It's the only reason those guys have a job. Now, here's a question. Jason, why are all these hedge funds and REITs doing build to rent? Simple. They have so much money to put to work, they can't do it 1 and 2 houses at a time. So when people start talking about, well, this REIT's not doing this anymore, and Zillow's not doing that, I'm like, yeah, they'd rather just go into a neighborhood. Here's 200 houses. They're all rented and brand new. Yeah, we'll buy all 200 of those. So that's where that industry is kind of going in the short term. But in any case, if rates stay above 6%, it's going to be a super chill market. It's going to be just like it was this last year, kind of mild appreciation. But what happens in an election year, guys? What happens in an election year? The what? Rates just about always come down. The economy's doing really good, and, we want to kind of get things juiced, and, somebody got to prop old Biden up somehow, so maybe lower rates, maybe that'll kind of get things going, right? So my guess is when we hit 23, I think these rates are going to come down. Affordable houses below $350,000 are going to continue to appreciate. If you look at the HAR report for this month, houses only appreciated 2%. Like I said, go into the data, look at all the houses below $350,000, they're up 15%. So that affordable house model, your choice is pay 7% interest rate or continue to live with your mom. Stay in your apartment complex, which, by the way, those rents are continuing to go up, or go buy a house. And I am almost sick of hearing this, even though it's as logical as it is, from mortgage people. Hey, you know what? You marry the house and date the rate. I'm like, all right, everybody got it. You can refinance in the future. I got it. And they're right. The principal of these houses is not going down anytime soon. So it's a lot easier to buy what you can now, because 6, 12, 18, 24 months from now, that house will be $40,000, $50,000, $100,000 more expensive. So why not just pay the rate now and then refinance in the future? Affordable houses, like I said, are going to be up probably about 15%. This is one of the most amazing metrics that I had seen in a while. 2019, if you had bought 12 houses in December of 2019, and the value of those houses were $185,000, today you'd be sitting on $1 million in equity. It was just an absolutely astounding. The reason I mention this is because right now we're in this lull in the marketplace. Like that's what it feels like. It feels just like COVID all over again. Here is the big fear when I talk to the real estate economists. Our inventory is already really, really low, like really low. These rates drop much lower. If we get in this 5.5, low 6s, 5.5, we have no capacity. Meaning, if there's all this buyer demand that just shows up in the marketplace, my God, we got to go and buy something today. You don't know when rates are going to come back up. Like we got to go, 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 go. All of a sudden, we've got zero inventory. Like Austin at one point had 0.6 months of inventory. They had 2 weeks of inventory. A normal market is about 5 months. They had no houses to sell. Now, what does that mean for you as investors? It is going to be impossible for you to buy properties in that environment. It's going to be really, really hard. But if you've owned these things for a couple of years, that's a really great time to sell them. Oh, this piece of real estate doubled in value in the last 2 years. Maybe I sell these 3 to pay off these 3. And I can tell you, although commercial real estate doesn't move as fast, you go buy a handful of apartment complexes, wow, this one's doubled in value because rents keep going up. By the way, increase in rates is putting pressure on rents, putting a lot of pressure on rents because people are not buying a house. Let's just wait. Let's rent another year. In fact, the real push right now, real interesting report, and I've not run the numbers for Houston, it's suburban rents. Since COVID, suburban rents are really up. Like stuff outside the central business districts, outside of the Heights, River Oaks, Westview, like the stuff outside of that has gone up substantially. And I think it's still going to until this changes. Putting a lot of pressure on rents. But the time to buy these things is now. Like you can't wait for the next shoe to drop.